This is a topic that we get asked an awful lot. Individuals, they come to us and very excited that they recently purchased a home and are excited to know what all can be used on their tax return as deductions and, if they're in credit, any benefits at all. So without further ado, we're going to get right into it. The first thing that comes to mind that we have on our list is a mortgage interest deduction. And, mortgage interest and property taxes, we kind of look at that together only because the information oftentimes comes to us on the same documentation. So, but those are items that can and should be included on your tax return, and they can make a difference. It does depend on whether or not you are itemizing on your return. But if you do have those items, you do need to have that as part of your tax filing.
So Stacey's referring to is Form 1098. And basically that form, normally you receive it from your mortgage company, and it will at a minimum show the interest paid during the year. Mm-hmm. So if your property taxes are escrowed, then you'll have the property taxes on that 1098 also. But, if your property taxes are not escrowed, then normally we'll get the 1098 that'll have the mortgage interest on it. It'll also have your property taxes. But if your property taxes are not escrowed, then normally we'll just have a statement from the township that shows property taxes paid for that year.
Your 1098 would come from your mortgage company. So in some cases, they will forward it to you, on their own via mail in January. But many times people will just download it from online,
yes,
from their account. And yes.
Yeah, we don't get mail too much anymore.
Yeah, it seems to be a thing of the past.
There's no mail.
Less and less things are getting mailed.
All right, so let's run down the list here. All right, so the benefits, tax benefits. We have our mortgage interest. We have our property taxes. First two. You also have
mortgage interest premium.
Yes, your PMI, the mortgage interest premiums that are deductible too. Points too.
Yeah.
Points. So if you decide that you want to pay down the interest rate when you grab your mortgage or you acquired a mortgage, you can pay points, pay the points. It'll, bring down the interest rate. And in that particular year, that first year, that's deductible also. All right. So I know the next part of this conversation is we're talking about property tax deduction. So before we get into that good question, I know the question everybody has, you have property taxes, and they're like, well, you can't even deduct the property taxes. You know what? We forgot one of the most important things. What we're smoking and drinking.
Oh, we didn't go over that, did we?
No, we did not.
Okay.
We're just so excited to just jump into business today. We're not having fun.
We talk tax all the time. We could take a little break.
All right. So here we go. What is the beautiful lady smoking on today?
I have a sweet Jane today. As you know, I prefer infused cigars, so the ones that have a little bit of flavor and a little sweetness. And this is one of my favorites.
All right. And we're drinking on a Cosmo, looks like?
That is a Cosmo. That is a Kettle One Cosmo.
Kettle One Cosmo. Right. All right. Good stuff. Well, I got the, base, old go-to, my father, La Opulencia, the green band, my father. It's supposed to be a full-body cigar. It's more like a enhanced medium-body cigar, but it is still very good.
Yeah.
There is no infused flavors, but this is a very, very, very good cigar.
That being said, I know that to be one of probably your favorite brand right now.
Yeah, favorite stick from my father is the 1922.
Oh, nice.
But favorite brand, yes, I smoke. My father's are very, very good, in my opinion, everyday stick. Match that with a Macallan 12.
Okay.
Yeah.
What you got today?
Yeah. The sherry cask, I believe. All right. Let's get back to business. Okay, so we're dealing with the tax benefits of owning a home.
Yes.
So,
We had stopped at property taxes. Were you about to say something?
oh, property taxes. Okay, so the first thing you're going to get every time when you get to talking about property taxes, home ownership, is, oh, you can't even write off your property taxes anymore. Or I bought a house and I'm not even itemizing. And hey, after, what was that, 18 when they changed?
18 Tax Cuts and Jobs Act.
That's it.
The whole tax return changed. Lots of changes to itemized deduction.
That was under our good buddy Trump there, right?
Yes, it was.
Yes. So what happened is pretty much doubled the standard deduction. And
Work-related expenses. Did a whole bunch of stuff.
yeah. Work-related. Oh, yeah, I remember that. Back in the day, you used to have unreimbursed employee-related expenses on the Schedule A.
Yes.
Shocked. Yeah. So what happened is you do still write off your property taxes, okay? You have what's called SALT, the state and local tax deduction. It's a $10,000 cap. So before that new tax law came out in 18, so we're in Jersey. We have lots of clients in Connecticut, Rhode Island, New York, and Jersey. Property taxes, very high.
Yes, these are states that are known for having high property taxes. We complain about it also.
Outside of Cali. Now, Cali's a beast also. But just to understand, back then we had, we still have. We have folks, they have $18,000, $20,000, $24,000 a year property taxes. And, before they were writing off their property taxes, they were writing off the personal property taxes
And then
and local taxes.
State withholdings that come out of your paycheck.
Right. So
All of that was grouped onto that one line.
and we had clients who that line would be $30,000-$40,000.
Easily, particularly if it's married filing joint, but oftentimes single too.
Yes. And what happened is we had, that SALT, limitation come out, and all of a sudden they went from being able to take that 30,000-40,000 a year to 10,000 max.
10,000.
Oh, now understand that hurt. I remember we were sitting around doing some planning around that because our property taxes aren't cute either. Now, they ain't no 20 or 30,000, but they're not pretty. But still.
It's worth mentioning that those tax changes are supposed to be on the books through 2025. It is possible. Not everybody, it's kind of, we have not heard.
I didn't realize they all, so all of the tax and job, it's sunset at 2025.
2025, there's been some.
That's why you should listen to her when she talks. Yes.
And we are hoping for them to revisit some of those things, some of those elements of those changes. But honestly, I haven't heard if they are. And I also, with this election coming up, I guess we'll see.
Okay. Oh, wow. You know what? It's funny. I didn't realize they all sunset next year. That's interesting.
Well, I think it goes through tax year 2025, so it might not be.
Yeah.
Do you understand what I mean? So, yeah.
Guys, make a note about that. That's a whole nother show. The Tax Job and Cuts Act, sunsetting. Yeah, that's a whole nother show. All right. We didn't spend a whole lot of time talking about property tax
It's
and personal property tax. Yeah.
It's kind of a big deal.
So the big thing is, let's just cap this the SALT line. On that line, you can write off your property tax, your personal property tax, which includes auto registration. You have a boat registration. You have trailers, your trailer registration. If you have a plane, your plane registration, you can write all that off there. And also your state and local taxes. That's that. Okay. The next thing is your mortgage interest. Of course, you can write off on the Schedule A your mortgage interest and the PMI, your, insurance premiums. Okay, so that covers those two.
Those are the top three, I would say. There's some other things that are worth mentioning. So if you have a business and you operate somewhat out of your home and you're using your an office space in your homes, you can use that on your tax return. Now, the thing is, you're not limited just because whether you have a home or you don't. I mean,
okay. So
When you own your home or you rent,
Yes. All right. So
patients, you're not limited.
yeah, you're talking about the home office deduction.
Home office deduction.
Right.
Yes.
Okay, so that's a tricky one there because, home office deduction, that is a benefit. Okay, so home ownership, yes, you can write off home office, but if you're renting, you can take home office also.
You can.
So I don't know that that's a benefit of home
That's not
ownership.
specific.
Right. And then when we jump into our series, we're going to talk more about businesses, especially LLCs, sole proprietors, sole member LLCs following the Schedule C. We're going to get into those deductions, and then home office is going to pop up there.
Right.
Home office is a heavy audit item.
It is. It is.
It's one of those things that, you want to document very, very well. And if we don't have to touch, we normally don't. But either way, we have home office.
That's this one. Additionally, there is the residential energy credit. So that basically means that if you have renovations and things that you're doing on your home that fall within the specific categories for this credit, you can take that. And things like a new roof, siding, exterior windows, doors, to name a few, there's a distinction that these items must be repaired.
Yeah.
So we get that question quite a bit as well. It does need to be replaced. You could be years patching and repairing your roof. That does not count. It counts when it's replaced. So
we have got a few clients walked in with those receipts for repairs done to roof. And what's that 20 credit? I'm like, no.
I do want to mention too, though, because one other thing that clients will come in and ask is, oh, look, I spent $30,000 on all these renovations. You are not getting anything close to that as a benefit on your tax return.
It's pretty much a 30%.
Yeah.
Wow.
It's kept at a certain amount.
Yes.
So, however, the thing is, if you spend the money, you took the time and did these things to improve your home, absolutely include them. I have a saying, which is, if you spent it and it's due to you, it's always better in your pocket than theirs.
That's a saying you have?
That's a saying that I have. Yes. Yes.
Stuff.
Yes.
All right. So let's step back a little here. Okay. So residential energy credit.
Yes. Why don't you tell them about the exclusion if they sell?
Exclusion if they sell their home? Okay. So residential energy credit. Let's just simplify it a little bit. The name, residential energy credit. It's basically a credit for you making your home more energy efficient. So doors, windows, heater, AC, roof, siding, all of those are included. You also have the solar energy credit. That's the biggie. That's the biggie. Everybody, they go to these folks, they get the solar energy panels. They always explain to them incorrectly how the tax credit for the solar energy panels work. So they always explain to them how the solar energy credits work incorrectly. That's always a thing. But,
that is a thing.
Yes.
Yes.
We'll have our folks, they'll get panels put in their home, and they're told they have a, 30% credit, which is true. That's not incorrect. But they're told they're going to get it all in that year.
Yes.
And what happens is you get the credit up to the point that you have tax liability. Anything above that is not refunded. It's just rolled over to the next year. So let's just say, for example, you have a $20,000 solar energy credit, and your liability for the year is $15,000. Well, you have the credit up to $15,000 to zero out your liability. Whatever you paid in, you'll get that back. But that other $5,000 from that credit, that's not refundable. All right, it rolls to the next year, and it will reduce your tax liability next year by $5,000.
I think what a lot of people end up thinking is, oh, I got $20,000, so my refund or what have you is going to increase by $20,000. It's not quite like that.
No, it's not exactly.
I think that's great that you laid that out.
That's it. Next thing is there's a few other ones out there. We don't have clients that have ever used wind turbines, but there is that credit for wind turbines. I guess if you're in the Midwest or so, you got enough room to put a big ass windmill in your yard. Okay.
Hey,
You know,
nothing wrong with that.
not at all. Not at all. Not at all.
And again, if you spent the money,
That is.
talk to your tax professional talk to your accountant about what you need to do to include it on there.
I'm just thinking, we got about an acre of land. There ain't no room there for no wind turbine. So it's like, you have to have acres and acres and
However,
acres.
there are lots of farms.
That's it. Midwest.
New Jersey. In New
Midwest.
Jersey, too.
That's true.
Yeah, there are some.
All right. So the little Philly kid is coming out, but okay. So wind turbines, you have your credit for that. Also, geothermal pumps. That's a biggie. Well, I don't want to say it's a big. It's a big conversation. Right. I don't think I've never had a client who had a geothermal pump installed. I think in recent years, there was a huge conversation about that with our clients in New York, and certain zoning, I guess, might have.
It's definitely costly to do.
Very costly, and with the zoning is difficult, but I guess it's available in certain areas for certain clients in New York now. But basically the way that works is still you got your 30% credit, but I think they trench like a couple 100 feet hole in the ground in the yard to put the geo pump thing.
I actually don't know. I just know that when we've discussed it, and they were considering it, it was quite expensive.
So the only time I've seen geo pump write-ups have been case studies. I've never had a client. See, so what I understand is about if you have a 2,000 square foot home, okay, to put a geothermal pump in there, that it starts around like $105,000. So that is a large credit, of course. And I heard it's a wonderful system. It's just where it's available. Okay.
Right.
All right, so I think that's it for the residential energy credit. All right.
I wanted to mention the capital gains exclusion. Okay.
That's a good one there. Yeah. So, see, that's a good one. Because I know everybody's sitting back and like, well, we can't write off all the property tax, so maybe home ownership isn't the best thing. Stop it. Stop it.
Yes, please stop that.
Stop renting. Buy your home. Buy a home. Okay. So, capital gains exclusion. You buy your home. And let's just do this by example instead of a book definition. By example, you buy a house for $500,000, okay? And, you turn around 3 years later and you sell that house for $740,000, okay? You made $240,000. We're not even going to deal with the basis which you put into the house and how to appreciate. We ain't going to go into all that, okay? We're just going to say you bought it for $500,000. You selling it 3 years later for $240,000. You have a $240,000 gain. Oh my God, capital gains. Because you're in the house, was it a little over 2 years? But you're in your home for a certain number of years. What happens is you have a $250,000 exclusion. So you bought the house for $500,000. You sell it for anything under $750,000. There is no capital gains.
That's correct.
Now it gets even better. You're married. All right, you're married. So you buy the house for $500,000. If you sell it for more than $1 million in a few years later, then you would have capital gains. But you have $250,000 for each individual that is added to the basis of that property, and there is no capital gains. Now, there is a time frame that you must be in a home. You can't buy this house, this is your primary home, you sell it in 1 year, buy another one, sell that in a year.
So if you're flipping properties, that's your business, that's not.
But we're not even talking about flippers here. We're just talking about folks that, let's just say they kept moving. Right.
Either way, yeah.
Yeah, so you bought a house in New Jersey, and then your job moved you to California, so you sold that home. You bought another house in Cali next year, then your job moved you to Nevada. You sold the house in Cali, moved to Nevada. Yeah, doing it that way, if you're selling in that short period of time, and you have a gain on the property, that capital exclusion will not apply.
No.
All right.
No. Yeah. So
I think that was the best way to do that one by example.
I think so. Yes. I think so.
All right. So I think that's it with the capital gains exclusion. What's the next item on your list there?
I think we've covered pretty much everything that we were going to.
Those are all the points for tax benefits for home ownership.
We did. I did want to mention that we're covering right now is mostly federal. For each of the states, they do handle that a little bit differently. So
The different deductions.
the different deductions
Yes.
that we've just covered,
Yes.
that would help on your federal side.
If I could.
Yes.
One big thing, and we do hear this often, we do get the folks that come in and, they say, hey, because they're not, their itemized deductions is not greater than the standard. There's no reason to itemize. They want to save on using that form, or if they're dealing with an accountant that charged by form, they don't want to have that form filled out, so they don't have to pay for it. Big, big, big mistake. Yes. So let's just look at your itemized deductions real quick. Okay, you have your medical, you have your taxes, you have your interest, you have your contributions, then you have your 2% deductions, all right? So let's just take the medical. If you take your medical, your property tax, all your taxes, your interest, your contributions, and your standard deduction is still higher than your itemized deductions, even though you're not getting the benefit of those deductions on that federal form, on the federal 1040, you still get that on your state. Let's just look at New Jersey. On your Schedule A, itemized deductions, your medical. If you say, well, it's not going to be above the threshold for medical, and I'm not going to be itemizing, so let's just skip. Let's not put anything on a Schedule A for medical. Then you won't get it on your state. So let's say you have $2,000 on that line, and you're not receiving that deduction on the federal side. That still rolls over to your state, and that's a deduction on your state. Your property taxes, even though you might not be itemizing on the federal side, so I'm not seeing a benefit of this. Okay, but those property taxes, if you do not include them on a Schedule A, then you do not have them on your state. So we still need to include all of these items.
And I believe most states do acknowledge the property taxes.
That's it.
Medical, I know that you mentioned that. Not every state does. But again, it makes more sense. It can't hurt to put out whatever it is that you would normally, just to see.
Right. So now to also deal with our peers, because we got some wonderful friends, and these guys are jokers. But anyway, they'll say, well, even if you don't fill out your Schedule A, you can still fill out those deductions on the state and take them, which is true.
You can.
How many people are doing tax returns by hand these days? Not none. Not none. Okay. I mean, now listen, I do come from that period where, we used to prepare, all tax returns by
tax office doing returns by hand.
That's it. And yes, number 2 pencils. We used to go down to the IRS office, grab stacks of all the forms, come back, and we'd have our little bins with all the forms. And from there, we do them all by hand. And yes, if you're doing it by hand, you don't include the medical and the property taxes on that Schedule A, you would still remember to include them on your, state reform. But nowadays, everybody's using software.
Yeah.
If you do not fill out, and it is a flow-through system, which means you fill out all the information in the beginning, you fill it out for that Schedule A, and it's going to flow through to all the appropriate states. And you don't fill that information out on a Schedule A, it's not going to flow through to the state. So for everybody who's sitting out there going, well, Layton, now hold on. If you don't have it on a Schedule A, you can still include all of this on your state. Yes, if you're doing it by hand.
It's a lot more complicated to separate it out that way. And most people are using software.
True. And I'll share something with you. I don't do them by hand.
Not if we can help it.
That's it. So all that being said and done,
thanks for joining us today for Cigars and Taxes. We just spent quite a bit of time going over tax deductions for homeowners. So things that you can use on your taxes if you own your home. Some key takeaways were the mortgage interest items, property tax. We talked about residential energy credit. We also made mention of the solar and other more extensive
wind turbine, geothermal.
More extensive. Yeah, there's so many out there. But the thing that you want to remember is if you have these items, you definitely want to talk to your tax professional or accountant when it's tax time so that they can kind of give you some guidance in terms of including that on your return and getting what is due to you for that. Okay?
All right. I think Stacey just covered everything. Only thing I would add would be, I think it was a good show, a good episode. Hopefully there was information that you can use here.
Okay.
Once again, this information is for entertainment purposes and education. So please talk to your financial professional about how to utilize these different credits in your particular situation. Also, do yourself a favor. If you're thinking about buying solar panels or, doing other work to the facility, your home, give your financial planner, your financial advisor a call ahead of time.
Yes.
Tell them what you're planning on doing so they can give you an understanding of how much the credit will be.
Uh-huh.
Do you have enough tax liability in any given year to use the whole credit? Or will it have to be extended over 1, 2, or 3 years so that you have a complete understanding? Some folks, they run off and they just go, okay, we're going to buy this, this solar energy panels, and we're going to spend $50,000 on it, and we're going to get $15,000 right back, so we only spent $35,000. And it's like, no, okay, because of where you are and because of your tax liability, you're going to get $5,000 back this year, $5,000 next year, and $5,000 the year after. So just be mindful of that and speak to your financial advisor. All right.
So hopefully you enjoyed the show. If you do us a favor and please comment below and subscribe. If anything, do you have anything else?
That's it.
That's good. Okay, our contact information is below as well.
Stay smoky.
Thanks so much. Have a good one.